Hello traders, welcome to the Forex Gig, where we dive deep into tools that can help you make smarter trading decisions. In today's video, we are going to explore the Forex Crossover Strategy, a straightforward yet very effective method to identify potential market trends and improve your entries and exits with timing. Stay with me until the end of this video as I will guide you step by step on how to use this strategy and how to avoid common pitfalls and combine it with other tools for better results. Now, what is the Forex Crossover Strategy? This strategy is a method that makes use of moving averages to identify potential market trends. A crossover happens when two moving averages of different time frames intercepts on your chart. This interception is often seen as a signal for a potential change in market direction. There are two main types of crossover you need to understand. The first one is the bullish crossover, which occurs when a short-term moving average crosses above a long-term moving average. This is typically interpreted as a signal for the market could be entering an uptrend. When the smaller time own, we are making use of the 9 EMA here. I'm about to change the color of the 9 EMA to red so that it will be better for us to understand. Now, when the 9 EMA, which is a smaller term moving average crosses above, it crosses and move above the long term moving average. That's the 9 moving average crosses above the 21 moving average. It signals a sign for an uptrend, as you can see from my screen. Then for a bearish crossover to occur, you have to see the smaller moving average or the short term moving average crossing below the long term moving average, potentially signaling a downtrend. So when the smaller moving average, which is the 20 EMA, crosses below the 21 EMA, it shows it's time for a potential bearish trend. This crossover helps you determine when to enter or exit trades based on the market momentum. The beauty of this strategy lies in its simplicity. By focusing on these crossovers, you can filter out market noise and focus on clear signals to help guide your trading decision. However, crossovers alone are not enough. You will need to combine them with other tools and analyze for better accuracy, which we will discuss in the later part of this video. Now let's see how we can make use of the Forex Crossover Strategy. To effectively use the Forex Crossover Strategy, you would need to follow a structured approach. This will help you identify a clear entry and exit point while managing your risks. Let us break it down step by step. First of all, you will choose a time frame, and I'm using the short term. I'm using a day trader's time frame because I want to make use of the short term moving average. Remember, if you're a day trader, you might prefer to use the short term moving average like the 9 EMA and the 21 EMA for quick signals. While if you are a swing trader, on the other hand, you would like to use a long term average such as the 50 SMA. That's the simple moving average for the 50 and the 200 SMA to capture broader trends. Now, as you can see my screen, I'm making use of the short term moving average, which is the 9 EMA and the 21 EMA. Then the second step is to identify your entry and exit points. Once you set Once you have set your moving averages, watch out for the crossover. This is a typical example. When to enter and exit your trades. Enter a buy position when the short term moving average crosses above the long term moving average. So we would enter our trade at this area where we see the short term average has moved over and above the long term moving average. You can enter a sell position when you notice this one is for a buy position. You enter the sell position when you notice the short term moving average crosses below the long term moving average. You can enter your sell position at the area. the Now the third step to confirming this signal or to confirm this trade is by using other indicators. We use other indicators to confirm such signals. The crossover are helpful but not always reliable on their own. To reduce false signals, confirm them using additional indicators such as the RSI. We can make use of the RSI, and remember the RSI, if you want to buy, it has to have a value of above the RSI has to have a value of above 60%. Look at this area we wanted to buy from. After the crossover, we will notice that the RSI value is above 60%. Once it's above 60%, it shows that yes, there's a strong uptrend momentum coming in, and the reverse is the case for below 40 points of the RSI. Once price is below the 40 points, you will know that you are expecting strong selling pressure coming in. Following these steps, now to set your stop loss and your take profit, risk management is very key in any strategy. So when we are taking this trade, we would have to place our stop orders just below recent support level. So putting your stop loss below this support level or this previous swing low is a very good place. While in terms of a selling trade, you would have to set it above your resistance area or above your swing high. Now for take profit, you aim for key levels, or you can use trailing stops to lock in profit as the trend continues. Key levels such as You can also make use of key levels such as psychological levels or the next resistance or support areas. Those are the key levels we make use of. By following these steps, you would have a clear framework for using the Forex Crossover Strategy effectively. Remember, it's important to practice on demo account first before adapting your approach based on the market condition. Now, let's look at the common mistakes we need to avoid making while taking trades using this strategy. Even though the Forex Crossover Strategy is a straightforward strategy, there are some common mistakes traders make that can lead to losses. Let's go over some of these pitfalls and how to avoid them. The first pitfall or common mistake we need to avoid is over reliance on the crossover. One of the biggest mistake is relying solely on the crossover signal without considering other factors. Crossover can generate false signals, especially in a sideway or choppy market where price movement lacks direction. So let's look at this crossover. You can see that some crossover. Let's look for a good example in a sideway moving market. Now let's look at this area. Let's look at this area in price. We can see that at this area price was moving in a sideways direction, and we saw a lot of fake signals. Price crossed over to the downside here, showing sign for bearish, and before you know it, it crossed over to the upside before it crossed over to the downside. These are fake signals that we can be looking at, or short-term signals. Look at this area, price crossed over the smaller EMA, cross below the larger EMA, showing a sign of selling pressure, yet price just sold for a short while before it spring back up. Number two mistake we make, common mistake we need to avoid, is ignoring the market context. Another mistake is ignoring the overall market context, such as economic news, the market trend, or key support and resistance level. Crossover works best in trending markets, but they can fail during major news events or when the market is consolidating. The number three common mistake we need to avoid is using stop orders. Failing to use stop orders is a critical error many traders use. Without proper risk management, a single bad trade will wipe out significant portion of your trading account. Let's not forget that we need to know where we put our stop loss. If you are taking a trade, let's assume we take this trade because price went, the smaller moving average went below the larger moving average. We decide to take the trade. Make sure our stop loss is above the high in terms of the last high, or the above the resistance line. This place is an area of resistance. You just put your stop loss above that place. That is where you place your stop loss. The fourth mistake that we need to avoid is overtrading. Overtrading happens when a trader takes too many positions based on every crossover they see, without considering the quality of the signal or the market condition. This leads to high transaction costs and emotional decision making. Now, the fifth common mistake we need to avoid is losing position for too long, hoping that the losing trade will eventually turn out good or turn around. This is another great mistake and common mistake that some traders make. This can lead to even greater loss as you hold your position that continue moving against you. To avoid these common mistakes, if you can avoid these common mistakes, you will improve your chances of success in the Forex crossover strategy. Always remember that no strategy is foolproof. Proper risk management and confirmation tools are essential for consistent results. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and share this video, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.